Well, it's been a week. I think we finally got that washout we were looking for. I had mentioned over the last week how the market had been kind of holding its breath and waiting and playing cautious and tiptoeing around all these issues that they saw out there. And I had mentioned that at some point it's just going to throw up its hands, wash everything out. I didn't use that phrase though. I think I said something more along the lines they'll dump it. They'll dump it and then they'll reevaluate. And I looked at the MOC yesterday, which I use a filtered MOC. I don't look at just the ones that start piling in. Um, if you go to Market Chameleon, it's a place to see market on close in a filtered way. And you don't have to buy it as long as you don't want to do anything with the data. You're not trying to correlate the data or read anything. I've been looking at that Market Chameleon every day for a couple of years. And you kind of get a feel for the numbers, and by itself, one set of numbers isn't enough to say anything, but you do see at times when things really stand out and or when there's significant changes. Yeah, I'm getting there. I always have to go through the YouTube stuff, and usually I just sit here quietly and I don't talk while I do it. But I'm trying to get in the habit of at least talking and chewing bubble gum and walking at the same time, maybe. Hey, I appreciate you asking because there's certainly a history of me streaming when nobody can hear, or I didn't get the screen shared like I thought I had. So I am grateful that you asked. So this is Market Chameleon. I don't have an account here. I've had one before. I didn't get enough out of the subscription to feel like I needed to keep it, so I didn't. And this is really the only page that I wanted anyways. To find it, you go to stocks and just come down to stock order imbalance. And again, you don't need an account to see this. You just need an account if you want to do anything with it. Manipulate the data, sort it, that sort of thing. And it only goes back 5 days if you don't have an account. I have all of this data in a spreadsheet that goes back a couple of years. One of the things that I do with that data is I look at what's being sold and what's being bought. If you were to go to Google Scholar or something like that and research market on close or volume at the open and volume at the close, there's a lot of data and a lot of background to that, why that volume is there, where it's coming from, how big institutions will position their orders at that time of day. And so for me, one of the things that always gets my attention is what was the buy number and what was the sell number. Now, this market on close is filtered, so the trade needs to have been at least 50,000 shares to count. And I kind of like that filter because you can do a market on close and I can do a market on close. Well, we don't count, we're not taking, 700 million shares of something. So I don't really want to see every order that went through market on close. And I don't need that notional value. I'd rather have, some sort of a filter. So I like this. And then the number that stood out yesterday was that 236 on the sell side versus 91 on the buy side. Now, look, if you've never seen this data before, take this with a grain of salt. This isn't sitting here saying that they're just selling everything and they're going to run us down into the lows. They have to sell something if they're going to get into something. So this could be nothing more than a rotation out of one industry or one sector just so that they can get into another. Okay, so don't automatically see that number and think that it's a negative. It could be nothing more than fractal rotation or sector rotation, and we need more information. One of the things that we would want to know is, what did they sell? Is there a particular industry that stands out? And if so, what do we do with it? So there you go. It's just another data point, right? Deal with it as you please. I keep saying I'm going to get good enough at Excel to turn this data into, amazing graphs and charts, and really get some fantastic visuals out of it. And I'm still not good enough at Excel to do that sort of thing, but thanks to AI, I am getting better. And right now, I mainly just use it for sorting purposes. I don't sit waiting for it, so I'm not sure how fast they get it onto the website. Usually around 5 o'clock, I come over and look and it's here. I'm sure it's there faster. I just don't know how much faster. I would say probably 4:30, maybe 4:15. But again, I'm not on the paid one, and maybe if I was on the paid account, it would be there faster. Not sure. The cool thing is they do offer a free trial. So if you want to kick the tires, I mean, you can't beat free. Sign up for free, you get access to everything, and then cancel that darn thing so they don't charge you for it. And that way they'll have more information in here, right? I'm pretty sure when I went through here that they had some sort of FAQ and some education in there too. So we're kind of looking at a mixed bag. Hong Kong is up the most, 2.4%, just blowout move. And I looked around for any subtle stimulus, and I didn't really find anything that stood out to me, but that doesn't mean that there isn't. I kind of got a little rushed this morning, and I didn't have a chance to look, everywhere that I normally would. So they're up. I have this sneaky suspicion that it is due to some sort of stimulus, but I don't know that for sure. Now it's up 2.3%. I mean, that's a big number. Yesterday it was brought to the attention. I think it was a couple of websites that I seen it, and then I heard two people talking about it, that the S&P hasn't had, a 1.5% move in a while, more than 100 days. And I thought, surely that can't be true, right? Not that can't be right. But there's that. And so here we're looking at Hong Kong, 2.4%. NASDAQ, more than a quarter. S&P, less than a quarter. Small caps, not even a quarter. And the Dow, not even a quarter. And then it just kind of falls down from there, with Europe under the zero line. And Japan is up at least 0.5%. They had news come through for the second night in a row. There's a lot to unpack in that, but things are starting to adjust a little bit. So we have today, Lisa Cook is going to speak. It's the Fed governor of, I don't know, one of those states. S&P Flash Services. We got Collins speaking today, and then we've got Kashari and Daly. It's a lot of Fed speakers, and I've kind of mentioned this before, and it's not always an easy thing to do, but all of these Fed speakers want to individualize themselves and show that they're speaking with their own voice, that they're not just some puppet, it was somebody else's words falling out of their mouth. But on the other hand, they're all really supposed to push the same message. And when you're on tune with them, you kind of pick that message up. And that's one of the things that is not always easy to do, but when you do it, you usually have a really good idea of what they're looking at going forward. And it's messaging from the Fed has been not wrong, but they've been kind of opaque lately. So it's worth checking out over the weekend since it is Friday. They'll speak today. Whatever they said can be regurgitated and reviewed through the weekend. You get a better idea of what the hymn book is that they're all supposed to be singing from. All right, so you can see today we have one major economic highlight, and then the rest are more of a minor economic highlight. And then, a lot of them are after hours. Don't worry about that rig count. So really, by the time we get into the afternoon, other than those Fed speakers, you should be good to go. And really, we're not expecting those Fed speakers to countermand or argue against whatever Powell just spewed the other day anyways. So, it shouldn't be some shocking revelation. But there's always this behind the scenes thing that the market can react to, like how many members argued against not raising rates or something like that. It just adjusts the sentiment. And if you think about the sentiment or the mood since Powell, it hasn't been all that fantastic anyways, which is where we sort of got this dump down into the market in the first place. So we're looking at US dollar Japan here. We had that breakout level and then we fell back down into it. It was looking pretty good. We got an outside bar yesterday, but we are bid right back up again today. And this kind of calls into question, are they going to intervene or not? And if they do, what's it going to look like? Are they going to get help from other central banks around the world like they did in October of last year? And so far, I haven't had a chance to go through all the data. There was just so much data last night. Let's go back there for a moment. If you look at the 10-year, the Japan 10-year, we are pulling back off of that high. So, I mean, that's good, but there's a lot of work here and this still looks very bullish. So let's put that on a weekly and it looks even more bullish, right? This is kind of the issue. They've made 1% their line in the sand. They said if we get there, they will intervene, but they have a history of intervening before it's needed or before it gets to the line that they've set. So that's why we're still looking for, some behavior before that. A quick flash, we'll come back and dig into these deeper, but we are risk on this morning, led by China with the KWEB constituents and emerging markets, which is, mostly China anyways, and some precious metals, oil, uranium, energy, nat gas, all of that energy, just different ways, some semiconductors thrown in there. And below all of that is where you start seeing things like technology, um, financials, Bitcoin, but none of those are up enough to hit our metrics, right? The things that are really leading the way this morning is China, and precious metals, and then all sorts of energy from different sorts and different kinds with semiconductors mixed in there. I made it sound, I guess, maybe like it's not very much, but it is a lot, and it's enough. It's that rising tide. If we can get this much going, we can get more going. All right. I thought I was logged into that, but that's okay. We'll come back anyways. All right, so we are running in an elevated volume this morning. It's not, like too much volume. It's nothing like that. As long as we're, not heading into the 220s, 250s, then it's not too much. And we're sitting in the 120s, so it's fine. You can see that red line there is the average at around 180, and that's for the entire session that it measures, and it's measuring from midnight to 9:30 in the morning. So if 180's the max at 9:30 and we're at 120 at 7:30, we're fine. We're within the average. If you look at yesterday, 150 FOMC day, we were at 74. It's not too bad. What does stand out though is this narrow range. We had that micro double bottom last night and then the move up. We didn't get a clean move through the kill zone. It was just this really wide, nasty chop. There is an inverse head and shoulder in all of that, but it's really nasty looking. It's really ugly, and I wouldn't try to trade it as a head and shoulders of any sort, inverse or not. And there just hasn't really been very much movement. And you take this low movement and add it to the fact that we have a market maker move this morning. Now we know that the market maker move is an indication of hedging in the front end, that they go in and they trade those options that are closest to expiration. That's what moves the needle on the implied volatility average in the front series, makes it higher than the next series out, and that gives us a market maker move. So they are hedging this morning, and it makes us wonder, what are they hedging against? We just looked at the news sources. There was only one major event, and surely it can't be enough to get them in their hedging, right? But at 9:45 today is the biggie. You're really going to want to keep your eye on it. If we get through that, then we're pretty much done for the day, other than those Fed speakers. So you should be good to go with your 0-day trades. And of course, since it's Friday, you got 0 days on anything that's got weekly options. I know that might sound a little Captain Obvious, but be amazed at how often just something simple like that is overlooked by newer traders. 0-day trades are, they're not that bad. I just don't like doing the out of the money stuff. To each their own. So we got a nice range. It implies there's a lot of work that can still be done if they're going to do any at all. If we take it out to the weekly chart, you can see how we made it to the 50%. 43.71 was tagged, and we're up off of that low, but we're still under the 10 and the 20 period moving average. We still have this low down here that could be tagged at 43.50. I wouldn't get overly hung up on that myself, but should we continue to go to the downside, that's going to be the area where we're going to anticipate some reaction out of the market. I was just checking this low here. We got close to it. We didn't hit it yet. But if we were to kind of just think about what these wicks imply, when we got down here before, they happily bidded it back up again, right? That there is a lot of buy orders down here. And when we got tangled into it, those buy orders did their job, and they were willing to pay that price, happy to pay that price, ran it back up. So until we know that there's no more orders there, we still have to have this anticipation that if we go down into that area, that there's still buyers ready to take it. That is the same logic we would use on any chart, by the way. So no matter what time frame you're using, that logic applies. Until proven otherwise, or until it's all absorbed, you can still consider that there is liquidity down there. Not necessarily looking at it to be support. Just a place where we could see a reaction out of the market. $10-day, 30-minute volume profile. The shallow area now is very present. It's easy to see. Even though we're building up some volume down here around that 4,400, I would still say we have the classic P shape to the profile. At some point, if we continue to build around here, it will turn into the B. We're just not there yet. It's very likely that 4,400 is going to become the new point of control, so that this will come down here. But there's a lot of work to do for that to happen because we're not very far out yet, right? If we do get back above 4,400, it is a shallow zone. Should be able to move back through it just as easily as we moved through it the first time. You can see how there wasn't really much there to hold us back. And it is interesting to note the amount of volume that was at this low. They were waiting for that one. We did spend a minor amount of time there, but still they were waiting on it. You can see it like an iceberg or a ceiling. All right, so the volume profile that we've had on the charts for a long time, that 4401 was hit yesterday, but it was also the round number, right? If we don't try to negotiate with that 1.5 points and just call it the 4,100, then, price really got hung up in that level. I'm not sure that I would consider it much value yesterday. I thought about it multiple times and I went in and I looked at it, and really it was just so close to the roundy that I didn't give it any real consideration at all, right? And I don't know. I kept it on there because it needed to be marked. It was a VPOC worth carrying, but it kind of goes back to the argument that I've made before. The the pivots only have value if we put them into context. Otherwise, it's just some line on the chart, and then even with that context, what are we marking it for? What do we think is going to happen there? What's the value of it? So, just kind of think about what's on your charts and how much clutter do you want on there? And is that clutter going to provide you with some false narrative? Like, oh, there's a VPOC, we're going to bounce down there. And of course, it just slices right through it. And either way, we took it out, it's done. When we put the volume down here this morning in a different light, we can see how much we had in the afternoon, even though we really didn't spend a whole lot of time in these areas. We still had a significant amount of volume. And we can see how that volume carried over again this morning. Now, granted, we've spent a lot of time in this zone since 1 o'clock. We've been in there just chopping about. So it makes sense that that's where the point of control is and that we have a lot of volume here. But it does highlight between this volume and this volume combined that there's a lot of volume down at this level. There is a way to combine those two, right? If you put a point of control, excuse me, a volume profile on the edge of the chart and just tell it to look at yesterday's and today's volume combined, you would see if there's enough combined down here to actually bring this point of control down here. We do have a VPOC now from yesterday. So should we move to the upside today, we're going to hit it. It's not much of a surprise that it's at the roundy. I think I took the tick off, but I think really it belongs there. I'd just rather have it nice and clean and take the tick. One tick either way isn't going to hurt anything. If we do make that break to the upside and we get through the roundy, just keep in mind that there is a VPOC there, but really the round number is going to have more weight than this VPOC does. Either way, it needs to be marked. We've got it marked. Be aware of it. Should we move to the upside, it's likely a place where price will respond, could get a first touch play at the very least. All right, and it's not a surprise, I hope, to anybody, but we're outside of the box and we're supposed to close in the box. So statistically speaking, we should close inside this box 8 out of 10 weeks, or 80% of the time. We do close outside the box once in a while, and it's not a big deal. One close out of the box, no big deal. End of the week, Friday close. What becomes a big deal is when we get multiple weeks, especially multiple weeks in a row, where we close outside the box week after week after week. That is a significant screaming alarm telling us, hey, something's wrong. We don't have that. Last week we closed inside the box, but look at the 2 weeks before last week. This week here, the first week of September, we closed out of the box. This week here, the last week of August, or the first day of September, however you want to say it, we closed outside the box. Then we had a week where we were in, and then we had another week where we closed outside the box. If I count back 10 weeks, we're not even like hitting 50%, you know, and the S&P is supposed to have that 80%. It's the only market that can, I don't want to say guarantee, but it has a history of hitting that 80% mark consistently year after year. It is one of the most accurate expected moves that exists in our markets, because it's the most heavily traded product that exists in our markets. All that extra trading gives the ranges more data, which makes it more accurate. And also anything that has, 5 expirations a week has more data, right? So they're going to be more accurate in their expected moves. So I guess the point is, when we're breaking at the end of the week, closing outside the box repeatedly, again and again and again, something's very off. It's very dangerous, and it's a warning. Right before COVID, right before the markets went down, we started breaking outside the box more and more. And it wasn't like COVID just showed up in one single day, right? There was whispers first, and then unconfirmed reports, and then confirmed reports of something going on, and those reports just got bigger and bigger, and it became more of a deal. But it unfolded over a period of time, and as it unfolded, the markets were responding to it more and more, and we started breaking out of those zones before the big dump. So, everything's connected, right? I don't know that we're going to close outside the box even now. There's still time left in the day, so we could rally right back up and get back inside the box, but that honestly isn't my base case argument. I don't see that on the docket today. We could, and I'm not going to discount the fact that we could, but it's really not present. We also have next week's range projected. It's not set in stone yet. That's important to recognize. The lines, when I look left, are set in stone. They don't move. But when we look right, this box is not yet set. And as price moves up and down, the box is going to move up and down, and it's going to widen and contract with the data. At 4:15 tonight, it's going to lock into place, and that'll be the new range. But one thing we can do early is we can take the existing week's range and we can compare it to next week's range. And what really stands out here is that next week's range has a lot more volatility to it. We know that there's more volatility because more volatility makes the range bigger. So it's not a massive, significant amount, but you can see on each side that there's more room, which kind of highlights that volatility that we're talking about. Excuse me just a second. I gotta fill this, move some positions around. Okay. So it's worth considering. Next week we got more volatility. You'll want to look at the calendar for next week and ask, what are they pricing in? Where's this volatility coming from? What's their risk or expectation? All right. One question I think that we're all asking is, are we due a relief bounce? Should I buy the lows? Did we move too far, too fast, and we're going to revert back to the mean? looking at the 10-week, we're not overbought, we're not oversold, we haven't gone too far, we didn't move too fast, and it doesn't owe us a bounce. But the weekly chart is a weekly perspective. There's a lot there, right? And on the week, we really haven't done all that much. So this, we're not even at 1.5%. And when we look at the average turnaround point, we actually need more data. So I'm going to add a couple more years to this thing. The turnaround point on average comes when we get below 2%, right? So we've turned back sooner than that. You can see these ones here. But for the most part, we don't start driving back above the 10 until we've gone at least 2% below it. Oftentimes it's more than 2, somewhere between 2 and 4, say around 3 is an average. The indicator doesn't look much like a wave, but that's really a good way to think about it. So let's flip this over and look at it from a daily point of view instead of a weekly. And again, we're able to ask that question: have we moved too far, too fast? We're 1.7% below the 10-day moving average. And when we look back, it's not the lowest we've been this year. Earlier this year, we were down 2.76% below the 10-day moving average. But I'd say if we get below 2%, that'd be a little more present. We got down there yesterday and we started to come back up already. So 2% started to be that turnaround point. Keep in mind that this can start to come back up and go back down again, right? So just because I mentioned that it's a wave and that we're already starting to come back up, it doesn't have to complete that wave. So, there's the ideal move, right? That it goes down and it comes back up. So we've started the move back up, but it could stall a couple times and struggle to do it. This could fit in the smaller time frame, say a 4-hour or a 1-hour, as having gone too far. And we could get a little bit of a relief bounce from that. Just mark 50% as your line in the sand, because if we're going to flip over and go back down, it'll be based on that, right? So I'll just put this on a daily here for a moment. $44.06 is the 50% mark. It's yesterday's midpoint. So in this move back up today, as long as we close below that 50%, the bearish posture that we've started is still in play. If we can get above that level, then we could argue that we're starting a recovery. Now, we've talked before about double bottoms and how a double bottom, a good double bottom, is a bear trap. But a trap is only good if it's convincing, right? So if it's not convincing, then nobody falls into the trap. It doesn't do its job and they have to do it again. So when I first started trading and I thought we had a low like this pivot here when price came back down to it, I was under the impression that we were supposed to just come down and hit the line and bounce and go. And that's how I tried to trade it. It didn't work. And that's because it's not what it's supposed to do, right? On any pivot, price isn't supposed to do that. Liquidity resides on the other side of the pivot. So it resides down here. And a really good double bottom is a bear trap. It should break the previous low because that's what it's supposed to do. And then it gets that liquidity and it traps all the bears, and then they spring the trap and they run it back up. The problem with this scenario is that sometimes we see a double bottom. We think it's going to be a bear trap. It breaks through like it's supposed to, and then it just keeps right on going. So how are we supposed to tell that it's a bear trap and that it's not just a bearish move that's continuing to go down? Unfortunately, there's no fantastic answer for that, which is why they say we can't call tops and bottoms. So rather than trying to assume that this is a bear trap and that we're going to go back up and that this is not just a mild pullback before continuing to go lower, we can actually wait for it to give us those signals either through a basing pattern or a V-shaped recovery pattern that we get a candle close or two moving back in the right direction. But we can also get above that 50% mark that I had mentioned. Because if we can get above that 50% mark and close above that 50% mark, then there's a better argument to be made that we're going to continue that drive to the upside. It's still no guaranteed line in the sand or anything like that, right? But it would be better than just hoping that this is a reversal. One of the reasons that so many people do trade it before it gives any sort of signal like that is because of an LRE. It's called low risk entry. So your smallest risk or your cheapest risk would be to buy it down at these lows. And if you're wrong, then you just take a small stop, you take a small loss, and you move on. That doesn't work for people who have an issue with losing. Hey, I don't like to lose, but not losing doesn't affect my strategy, right? I don't do everything under the sun. I won't pile hundreds of thousands of dollars into a trade just to avoid taking a loss. I don't have an issue with taking a loss. If you do, LREs are not your jam, right? Just leave them alone. And it's only a low risk entry if you keep the risk small and manage the trade effectively. If you're getting that quick entry off the low and then you don't manage the risk and it ends up being a big loss anyways, then it wasn't a low risk entry for you. Right? So just kind of keep that in mind. So looking at what we got now that we've taken all the clutter off of the screen, we've got our ADR 43.94 to the upside, 43.46 to the downside. That's the ADR half. A full ADR would be 44.18, and we can add another $10 to that for the market maker move. It doesn't owe us a move, by the way. If it holds this low and goes into the close, the market will be satisfied. If it breaks the current low, we're very likely going to take the full ADR today. That'd be 43.22. Can be all the way down here. I really don't think the market is going to tolerate this low. So if we get down there and we get through it, we'll very likely see another wave of selling. Yeah, it would be great to know, if they're flipping it over on us. There's some tactics to that, watching for volume, going to the smaller time frame. I tend to look at all the pieces and then build a picture from it. So when we get a double bottom break on whatever time frame I happen to be trading, before we even get to that bottom, let's just go to the daily because it has the image we need. But imagine this daily chart is a 5-minute chart, right? Before we even get to that low, I'm considering the idea that, ooh, we might have a double bottom coming. And then I think, well, okay, we're going to break through the double bottom and we're going to turn around and maybe we'll go back up. And I call timeout on whatever it is that I'm doing, even while we're still sitting, say, up here. And I start looking around the market, tick, trend, U-vol, D-vol, weighted AD, bonds, dollar, the VIX, because I've got all this time. I'm no rush, right? We're not even down there yet. And I look at all those different things and I try to evaluate, do we have a chance to bounce down there? If we start to turn around, is it really going to come back up? And by looking at all those things, it helps me build a bigger picture on being able to answer that question. Because honestly, the answer to the turnaround isn't going to come from the chart we're trying to trade anyways. It's going to come from that bigger picture, what the bonds are doing and what yields are doing and all of that. It does help. I won't say it's 100%, but it does provide a lot more context to whether or not that flip is going to come into play and if they're going to be able to hold it or not. Come on, Thinkorswim, don't freeze on me now. Yeah, experience helps too. Absolutely. So as I mentioned earlier, KWeb is leading the upside drive. MCHI and EEM, those are all basically China. And then Nat Gas, which isn't overly exciting in any way. Then we start getting into energy names like URA. So we got uranium, we've got energy. We are starting to see some spiders coming in, like communications, XLC, XLY, consumer discretionary, which has Tesla in it, no less. So, you know, it's most heavily weighed by Tesla. It's not the only thing in it. We also got the precious metals. And we almost have technology. It's almost there. So it's getting really close. I'd like to see more out of finance this morning. We don't need it. Just to be clear, we don't need it, but it would be good to have, right? So if we think of the market in this grid, the top three names are the risk on sectors, and the bottom three are the risk off. If we're going to have a risk on day where we get that rally in the markets and we're headed to the upside, and we want to see at least 2 out of the 3 on this list. Usually it's technology and consumer discretionary, or it's finance and consumer discretionary. Consumer discretionary is like the follower, you know, kind of a yes man. So we really don't want to see it lead by itself. We just want to see it play wingman to one of these other two. So right now we have tech and consumer discretionary. If we can get tech with finance working together and then back it up with consumer discretionary, we can get a real run today. A lot has changed in the last year or two, and it's been hard to find a day where we rallied with only finance or finance and consumer discretionary. So while I say it is possible to have that kind of day, it's been a long time since we've seen one. We don't have to worry about it today anyways, because finance isn't leading. But keep your eye on it, because if it does start to pick up, then that's the missing ingredient, right? That's the last thing that we would want to see, or the final thing. Say it, that makes more sense that way. The final thing we would want to see for a true rally to take off to the upside. When I'm sitting here on this 15-minute time frame, it starts to make clear, you know, the true move over the last few days. But let's just take it out a little bit farther to the 1 hour, because this kind of puts it all into light, right? And if we're going to get that move to the upside here today, we got that little zone at the top of this candle from 89.5 to 92.5. I'll just steal a tick. If we can get through that zone, then we can really start working things through. And what's encouraging, at least as a starting point, is we're through the 50% mark of this last big bar. So 43.81. And I think as long as we can hold that 43.81 as a good starting point, then we can slowly start to rebuild and come out of this mess. So one step at a time. Let's get into the open, get that shake through the market where it digests all the news and prices in the news from the overnight hours, hold that 43.81 and then get out of this candle. And we'll focus on the next candle and start working our way back up. If we continue to go to the upside, one level of particular concern is going to be yesterday's RTH open. It's 44.11 basically. It's a cog line. If we get there, just be careful. We're very likely going to have a first touch rejection. It's going to struggle to get through that zone. All of the FANG names are up this morning. At least they were the last time I looked, which was before the stream started. Microsoft was getting some news this morning about their acquisition. They've been trying to get this deal done for like, I don't know, over a year. And apparently it's finally starting to see progress. All of these generally move together. And there's been a lot of disconnect this year. So they're not as paired as they used to be. But so far this morning, yeah, so far this morning, they're all still up. A gap that needs closed on Tesla and Nvidia. So getting to Wednesday's close would be the goal. Same thing with Google and with Amazon. Now, I've been watching Netflix close because of this really tight consolidation. And even though we had that little extra move to the downside, I still think this has the capacity for a nice U-shaped play. It is primed and ready to go. So if we get through Wednesday's high, I think this will be a fantastic rip, and that'll get at least 3 sizes of Wednesday to the upside, right? That it'll be one of those days, kind of like a TRB setup. One of the reasons we like the TRB so much is because of the oversized candle that we get when it does make that breakout move. Unfortunately, there's a lot of work to do. We closed at 384 and we're only at 385.80. So, well, you know, between 80 and 20, you've got to split the mid. Either way, we're not even at 386. We can say that. And the high here is 397. It's not even the high, it's the open, but I'd rather focus on that open than the actual high on that candle. And that means getting out of this for the run today, not likely. But for the start of next week, if we are going to start to turn around, this comes into that low risk entry again. How much of a play are you willing to take here for a move back up to 40.40 or 450? Because that's what's on the table, right? So I'm going to be looking at options today, something out of the money in that range. I don't know, maybe a butterfly or something like that, so we can keep the risk really low. I'm not interested in gambling with a large sum of money, you know what I mean? But a butterfly is a very cheap trade that has a fantastic payout when it's right. And that's the way options work. The lower your probability of winning, the higher the payout will be if you do win. And also the lower the loss if you're wrong. Butterflies don't have a high win rate statistic. But the butterfly or options in general, it doesn't know what's high probability or low probability as a pattern or as a setup. It only knows the numbers that it has in the money, at the money, out of the money, and by how much of the cost. And it uses those numbers to decide if your trade is a high or a low probability. So if your candle setup or your pattern setup says you've got a high probability trade and you can get the market to give it to you for a low probability cost, there's your edge. So I think a butterfly around that 440 or 450 area might not be a bad way to go. I don't know that I'm going to skew it or do any kind of broken wing or not yet. I'm still considering what those options are going to look like uh, as we go through the day. If I do put anything together, of course, I'll post it so you won't miss it. For NVIDIA, I would focus just if there is any kind of up move, it would just be to get this gap closed. That would be my only concern at that point. I wouldn't even try to take this as any sort of a swing back out. It doesn't have the same shape as this Netflix move. And for Tesla, it really looks like it wants to complete that island reversal. So it's supposed to pop up, build an island, and then pop back down, and that completes the island. The gap to close is 248.5 to the downside, or we'll just take this line here. 262.46 to a gap move on the upside. So that thing's got gaps all over the place, right? Meta rallied up and is all the way outside of yesterday's candle, which is fantastic. You get this doji candle, lots of indecision. And now this morning we've rallied all the way up, and I misspoke. We're not outside that candle yet, but we're very close to being outside that candle. That's what I would focus on. Meta's getting some flows, right? And who cares why, right? It's not like we're taking a long-term trade here. We're talking about a trade for today. So we're getting some flows here that look good, and got the S&P continuing to drive to the upside. Looks like it really wants to take things back. That's a fantastic push. Let's get through that zone. There was news on advertising, so that's why we're seeing communications names go up. It wasn't necessarily Netflix per se. Amazon had news about adding commercials. Netflix had news, well, it wasn't for Netflix, but there was news about the Writers Guild strike maybe ending soon. That's going to help with all the streaming services. So looking at Netflix in the pre-market here, we're starting to get that bid up a little bit. Of course, with the indexes themselves getting bid up, it might not just be Netflix. It's, it could be more. And then for Meta, I didn't see any news this morning yet on Meta, but that doesn't necessarily mean anything. Nothing in this news yet. Target got an upgrade, and Costco, Crowd, Nike. Well, I said upgrade, but I might have misspoke it because it's just rate changes, not necessarily up or down. Beyond Meat, Crowd, Costco, all of those got some sort of analyst upgrade or analyst downgrade, but I'm not seeing Meta in there. So at least we know it wasn't from any sort of rate change. Just says broker action. So there we go. 1% move in Meta pre-market after broker action. So could we have some dealer brokers managing their deltas, adjusting their gamma? I don't think it's going to make any difference, but Apple's phones go on sale today. So this is an inverse head and shoulders on NVIDIA. Depending on how you want to measure it, and I'm going to measure it in a conservative way. We're looking at 428.65, which ties us right into this resistance or this previous pivot point. Same thing with Tesla, inverse head and shoulders. You're going to find that pattern on most of the markets. 266, 263 is your first level, which would be right into this zone here. Anyways, it makes sense. All right, watch for a pullback. We're getting right up into the 50% mark of the measured move. So SPY is about to hit something and digest a little bit. And then if it keeps the drive going, we can make it up to that next level. So it's looking pretty good. We've got kind of that rising tide and in the right spaces. Zero gamma in the SPX 4436, in the ES 4478. There's a call wall at 4642. I don't think we have to worry about that. 4600 in the SPX. And 0.82 is going to be that line in the sand. If we get that far, we're very likely going to digest, which would be somewhere around that ADR half level. If we get through 0.82 and we continue to expand, we'll very likely take another 50% on top of that. So if the S&P moves, 0.82 and gets into 0.85, 0.86%, we're very likely going to go 1.2 to 1.6. Right now, SPY is basically flat, and the ES is at 0.4. I think maybe Thinkorswim is a little confused on that SPY value, but we're halfway there. This is saying that we can move another 0.4%, and that'll be just about it. I wonder how close that gives us to that red line. It puts us to 4,400. Closer to the yellow line than the red line. Somewhere in the middle of these two. So cool. It's a little more than I thought we'd have. Let's finish it up like this. This is what we got out there, right? And these are the right sectors. You don't want a rally that's being held together with pot stocks and nat gas, right? That That just doesn't inspire confidence in a market rally. But when you've got China ADRs, nat gas, airlines, precious metals, various energy sectors, technology, consumer discretionary, you've got a much wider swath, right? Home construction, building materials. That's a rising tide right there. That's looking really good for a continuation into the end of the day. And a good start to next week. We're continuing to see the 10-year breakdown. This is a fantastic move down, which matches that move up that we saw in the ES. US dollar Japan back down to the low of this pivot. It'll be better if we break that pivot and continue moving to the downside. Got the Dixie breaking back below the 50% mark of yesterday. So that's a really good start. You see that fantastic move in the S&P. Even the same thing in bonds. And energy's backing away. Okay, that's a little weird, but we'll take it, right? That move in energy, some of that move yesterday was from Russian news. So keep your eye on these bottom three for the ES rally today and the NASDAQ. As long as we continue to see these bottom three not rally, they don't necessarily have to continue to fall, but not rally is really important. Then we're going to expect the indexes to continue to move, and that should give us some fantastic day trades. One place that I'm going to be looking at for day trades today is going to be the banks. Because so far, looking around, they haven't gone anywhere really yet. And if they do start to join in, I'd rather trade something that's only up, a 0.5% than trade something that's up already 1.5%, right? That's what I got for you guys. Be careful, be safe, have a good weekend, and we'll be back to do it again next week.